Hi, I'm Sean Alaband with Code Accounting, and we prepare tax returns and compile financial statements for small and medium-sized businesses across the United States. I'm here today to talk to you about operating in multiple states and how that can affect your taxes and financial statements. Running a national business is like playing 50 different board games at the same time. There are different pieces, different players, different penalties involved when you get things wrong. And so it's important that you know what to do. And it's important that founders know that they're playing this game in the first place. One good example of this is with sales taxes, because that will vary greatly across state bounds. For example, in California, you would be assessed sales taxes based on where your customers are. And in other states, it might be based on where your location is for your store. Once you operate in more than one state, you can't simply choose to pay tax in your home state. You need to apportion income to the states where you have economic nexus and pay taxes in those states as well. There's frequently an exclusion for the taxes that you pay in other states so that you are not double paying taxes. But if you get this wrong, you can end up paying more than 100% in taxes. And this is something that I've seen before. One common mistake is the secret remote employee. An example of this would be when an Oregon company hires an employee in Colorado, and then they continue operating in Oregon as if they're an Oregon-only company and only paying taxes to Oregon. Colorado is going to assess nexus on your business because you have a physical presence in their state. That means you're subject to payroll taxes in Colorado, income taxes on the income earned in Colorado, and you'll need to file payroll tax returns and income tax returns, and most likely register your business to operate that single employee from the state of Colorado. So some people think, how would the state of Colorado find out about this? Well, it happens when employees file unemployment insurance claims. Then the state of Colorado becomes aware that you are employing someone in the state. They'll check out your books, probably give you a full audit, and at the end, they're going to ask for payroll taxes, income taxes, penalties, and interest on all the money that you would have owed since you started hiring that employee. Nexus is like an invisible fence around each state. And once you step into that fence, then you need to pay all of the taxes to that state. You can achieve nexus in two different ways. One is through physical nexus, and the other is through economic nexus. You can think of physical nexus as boots on the ground. This is whenever you have an employee in the state, an office, inventory, even a salesperson. Economic nexus can be thought of as transacting business in that state. You don't need a physical presence. You only need to have economic activity that exceeds a certain threshold. That threshold is most commonly set at $100,000 in transactions or 200 transactions. And that or is very dangerous because you might have 200 very small transactions. Maybe it only adds up to $1,000. You might think that you're exempt from paying taxes in that state because it's such a small dollar amount, but you would be incorrect because the number of transactions has exceeded the threshold for nexus in that state. You can think of remote employees as Trojan horse. You know, they let them in and then all of a sudden you're subject to taxation in their state. So be careful if you're, for example, hiring a consultant in Ohio. You're immediately subject to Ohio taxes. Doing business from a state with a location in that state means that you've entered the economic ecosystem of that state. So you might be doing things like signing contracts, setting up offices, signing leases, and that subjects you to legal ramifications. And if somebody decides to sue you in that state, you want to make sure that you're properly registered and you've paid all necessary taxes, so it's not something they can hold against you in court. If you're doing business in that state, but you are not registered to do business in that state, then you lose the right to sue anyone for any damages that you incur in that state. One big misconception that people have, especially because of the older rules around this, is that SaaS is not taxable. But recently, with the development of more and more SaaS products and more SaaS companies, there are now 20 states across the US that tax SaaS sales. So you need to be aware of your nexus in those states and you might need to be charging sales tax on your SaaS subscriptions. Income tax nexus is fairly straightforward compared to other types of tax nexus because what you need to do is identify the source of the income. And each state will have its own source income amounts where you can claim the income in that state and pay taxes only on that state's sourced income. The remainder or any unallocated income would be taxed by your home state. Sales tax nexus is the really complicated one because there's over 13,000 jurisdictions across the country. That's because there's a state level sales tax, a county level sales tax, a city level sales tax, and sometimes there might be other jurisdictions, such as in the state of California, where you pay tax for the destination and from the shipping point. So it gets pretty complicated fast with all the different jurisdictions involved and all the different rules in each of the jurisdictions. One example of a complicated law is in the state of New York. A sliced bagel is taxable, but a whole bagel is treated as a grocery item and is not taxed. You also need to be aware of triggering gross receipts and franchise taxes. Some states will tax you whether you earn profits or not. Those states include Delaware with their annual franchise tax, California with the minimum franchise tax, Nevada with the commerce tax, Ohio and Texas also have gross receipts based taxes. And those taxes are assessed based on the income you bring in, not the profits that you earn. So there's a few key records that you want to track to make your sales tax position more defensible. One record that's good to keep is where your employees are working from month to month. Another is where you're shipping to in terms of states and sometimes in terms of individual jurisdictions like cities and counties. You'll also want to track exemption certificates. You might be making a sale to a reseller. They are claiming a sales tax exemption. You'll want to save their reseller certificate to prove that it's a resale transaction and that it's fully exempt from taxes. So what happens if you ignore all these complicated rules? Well, the states can audit you. They can go back for up to 3 years and they can assess taxes, penalties, and interest on everything that you would have owed. And so this can really add up and be a financial burden if you don't take care of your reporting responsibilities early. There are 3 states that taxpayers most frequently run into issues with. Those states are California, Texas, and New York, of course, because there's so much activity in those states. I'll go through each one of those individually. California is known for its aggressive enforcement activities. You create Nexus in the state of California when your transaction volume exceeds $500,000. And when you have Nexus in the state, you are required to pay an $800 minimum franchise tax every single year. Sometimes more if your gross receipts exceed $250,000. The big trap is the doing business from rule in California. That means that if you have an entity outside of the state of California, but you're managing it from inside of California, then you are still subject to California taxes. And they're going to come after you for all of those minimum franchise taxes and LLC fees that you may have needed to pay during those years you were managing the entity outside of California. That's why a lot of people get caught up on that and end up needing to pay the franchise tax board a lot of money. Texas is unique because it doesn't assess a state income tax. So a lot of people assume that they don't need to pay any taxes to the state of Texas, but that is incorrect. There's what's known as a margin tax that gets assessed on your business gross receipts. And so that's something that you cannot deduct cost of goods sold or any of your expenses from. It's based on the amount that you earn in top line revenue. And even if you qualify for the exemption, which is under about 2.5 million in gross receipts, you still need to file the tax return, even though you're not paying any margin tax. If you fail to file that tax return, then your entity is forfeited in the state of Texas. New York has a well-known convenience of employer rule, and that states that even when your employees are working outside of the state of New York, then the state of New York can tax your employees' wages up to 100%. Yes, the employees that are outside of New York. There's also a New York City tax that you need to be aware of because auditors will routinely check travel logs and receipts to see where work and duties were actually performed. States will usually assess their taxes based on what's called a single sales factor. That means that if you have 10% of your revenue coming from that state, the state will usually want to tax 10% of your profits. They allocate their taxes based on the percentage of the income that you earn in their state. One common mistake is confusing where the work is done with where your customer is. Market-based states tax you where the customer receives benefit. So if you are operating in Ohio and working out of Ohio, but your customer receives the services in California, then yes, California will want to tax that income. So there is what's known as a compliance trinity that you should keep in mind. Anytime you cross the nexus threshold, you're going to need to file income taxes, sales taxes, and an annual report with that state. So keep that in mind and check your nexus regularly. Here is one of the most overlooked steps, and that is registering in a new state. If you, for example, register in Florida and you move to the state of California, you need to register with the California Secretary of State before you operate in that state. Otherwise, you are operating off the books and illegally, and California courts will not enforce any of your contracts. It's important to register before paying your first payroll tax, especially because employees will normally create nexus. And it's also important to register for sales taxes immediately. As soon as you cross that nexus threshold, register for sales taxes and start tracking your sales tax transactions. It's important to call a CPA when you run into complicated tax scenarios. That might be hiring your first employee in another state, crossing the $100,000 threshold, transacting large contracts or other business agreements in other states, hiring third-party logistics or Amazon fulfillment, and of course, interacting with states that are strict about this. States like Texas, California, and New York. Don't let taxes stop you from hiring great people in other states, but also don't ignore the rules. Multi-state tax compliance is not optional. There are a few things that you'll want to keep in mind when hiring a remote worker out of state. First of all, you'll want to do a cost analysis to see if the additional expense and administrative burden of hiring that employee outweighs the cost savings of going out of state. You'll also want to process the foreign registration in that state and register your entity, and then register your entity for payroll taxes so that you can pay that employee. And lastly, you'll want to make sure your workers' comp insurance coverage covers the employee in that state. If you want a clear plan for multi-state tax compliance, then book a call with me. The right plan today will prevent a six-figure tax bill tomorrow.